Now we're going to kind of get into the buy and sell signals and how the follow-through day becomes a buy signal. So this is on page 43. So you'll see throughout the day that there are a lot of moving parts, but again, like Charles mentioned, in the battlefield you only have to look at one day at a time. Today we're going to be looking at bull markets and corrections and such, and you're looking at a lot at one time, but every day you're only going to have to look at it and say, okay, what did the market do today? Did any buy or sell signals get triggered? So with our buy and sell signals, we have them noted as a B for buy and an S for sell, and you'll have a number next to it. And the reason why we did this is not to get you to memorize a bunch of letters and numbers. It's just so when we would mark up the chart that it makes it easier, because you can't write follow-through day and distribution day and everything without it getting very cluttered. So a follow-through day of B1, that's what gets us started. We're going to buy on an initial follow-through day. You may use a follow-through day from an index other than the NASDAQ, but then you must stay within that index for future buy and sell signals. So if you get a follow-through day on the NASDAQ, that's great, and then you're going to follow it the rest of the time, but you can get it on the S&P 500, the New York, the Dow. Then it becomes a little bit tricky if you get a follow-through there before the NASDAQ, because then you're going to have to decide whether you're going to switch over to the NASDAQ if the NASDAQ gets a follow-through. And that's what I would do. And the NASDAQ follows what our stocks do closer than the S&P or the New York. That's really a personal preference, but Charles and I would both use the NASDAQ. Now, this initial follow-through day, this is very key, is going to reset distribution. So you can have 20 days of distribution, you get a follow-through day, it gets wiped out, we're back to 0 days of distribution. It's very important. Now, a B2, additional follow-through days, those are the ones that we marked on the chart, we're going to buy on any additional follow-through day that happens within 25 days from the rally. That's why I was saying that the rally day becomes important, because we have days attached to it. Whereas with the follow-through day, most follow-through days are going to happen between 4 to 10 or 12 days from the rally. Sometimes you do get them in the 20s, and a couple cases all the way out in the 30s, but we're not going to count additional follow-through days that far out. We have other rules that will pick that up. So again, we're going to buy on any additional follow-through days within 25 days from a rally day that close above the low of the initial follow-through day. So the concept there is, if you get a follow-through day, you want to only be buying if you're actually making progress. So if you have a follow-through day up here, and then you get another one down here, you're not going to act on it because the market isn't moving up. So that close has to be above the low of the initial follow-through day. And the additional follow-through days, it's just a buy signal. It does not reset distribution. Does this make sense to everyone so far? Really, with all these signals, in most cases, you'd buy in the last half an hour. If it's really critical and volatile, maybe you'd wait for the last 10, 15 minutes. But most days, it's going to be pretty clear early on, especially if it's a big gap up. Any other questions? Yes, sir.
Usually after a deep correction, a long correction, you sometimes market can go past 25 days in a rally. What do you do at that point? Do you add more if there's additional follow-through days past 25 days?
We have another rule that we're going to talk about a little bit later. Charles will talk about it. That it's a little bit more restrictive. It's called an accumulation day that we would act on. So after 25 days, then it's almost the same thing, just a little bit more restrictive. And you would buy on those days. Yes, sir.
What is initial follow-through day, initial follow-through days do not reset distribution.
The additional follow-through days, that doesn't reset distribution, and the reason being is it's just another form of strength in the marketplace. So it's just like going above a moving average that we're going to talk about in a little bit, or an accumulation day, or many other strong days that happen in the market. You can't reset your distribution count because of those. It's only when you get that initial follow-through day. And the reason is, you're saying we had a correction or a bear market, that's in the past, now we're starting fresh. Now we're going to start counting the distribution going forward. And if we did that every time we get any form of strength, like this is just another form of strength, you would never have enough distribution that would be meaningful. So that's a fair question. Yes, sir.
What did you say about buying in the last 30 minutes or 15 minutes of the market?
So with these signals that you're going to see throughout the day, whether it's the distribution day or there's a lot of different rules that we're going to talk about, Most of them you're going to have to wait until the end of the day to get a sense of, is it really going to trigger that rule or not? Some of them are going to be obvious. We have some things that are called a bad break, where you're down a whole bunch in the day. Well, you don't really have to wait until the close of the day. You can start taking action. But if you're going to follow the system, you want to follow it as closely as possible. So the reality is, if you can wait until the last minute of the day, great. That's how we've done all the back testing with the close of the day. But the reality is, you've got a portfolio full of 5, 8 stocks, maybe more. If you do all your trades related to market school rules in the last 15 minutes, last half an hour, that's the way I would suggest that you do it. Now, you'll see that with our rules, we kind of have them in families of buys and sells that kind of counteract each other. So on the follow-through day, we also have a follow-through day sell rule. This answers the question that you had earlier. So a follow-through day undercut, that's our first sell signal. It's called an S1. Sell signal 1. We're going to sell if the index closes below the low of the initial follow-through day. It does not apply to additional follow-through days. So the concept here is, you have a follow-through day, kind of like we were looking at in the bottom of 02, and you undercut that. That's okay, but if you close below the low of it, you need to start backing away. And so it's not saying that you're out of the market, it's just saying it's a sell signal, and you're going to react on it. So the close is below the low of the initial follow-through day. Not an intraday pierce, but an actual close. And again, it doesn't apply to the additional follow-through days. Now in S2, this is a big one. We're going to sell if the index undercuts the major low, and that's like a 2002 that we were talking about. A real bear market is a major low of a rally attempt. So the market exposure is reduced to 0 and the buy switch is turned off. This is a really major rule, and it basically says that the low, once you've undercut it, you go out of that market because you don't know how much lower it's going to get. Many times, it's just a shakeout. It just pierces below it, goes right back up. That happens a lot of the time. But we need to be prepared for the ones that keep going down and down and down and down. So even on an intraday basis, so you were asking about the last half an hour, this is one, when it happens intraday, you act. If it happens in the first 5 minutes of the day, you act. You don't wait until the last part of the day. Now, the major low of the rally is defined as a low that occurs when the buy switch is turned off. So if the buy switch is turned off, it becomes a major low. And you'll see on the charts as we go through it what the buy switch turning on and off. So this is kind of getting ahead of ourselves, but it just had to be in this section. So don't worry if that's very confusing, because it should be confusing right now until you see a lot of this stuff in action. So sell if the index undercuts a minor low of a rally attempt. The market exposure count is reduced by 2, and this does not turn off the buy switch. A minor low of a rally is defined as a low that occurs when a buy switch is already on. So this probably sounds like just a bunch of noise at this point, but it's going to make a lot of sense as we go through the day. So the concept is really, at a major market bottom, when you undercut the low, you get out of the market, and you turn off the buy switch. Means you can't buy until you get a follow-through day. When the minor low, that's when you've been going long and you've had a lot of distribution. Once you have 6 days of distribution, you need to start looking for a follow-through day to reset the distribution count. And that's just how the system works. But sometimes you can get a lot of distribution and the market doesn't come down, like what we've been dealing with recently, where you have more than 6 days of distribution and the market keeps going up. Well, if you have a rally day and a follow-through day during that time frame that's really an uptrend and you undercut that, we didn't want to say you go to cash, because it's just basically, if the distribution isn't killing the market, then the distribution just isn't working at that time. So to sell everything because of an undercut wouldn't make sense, and it's not what Bill would do. So all of what we're doing with this system is just trying to think, what would Bill do? How would he react in different situations? And if you undercut a major low, he's going to sell everything. If you undercut this other thing, he's going to sell some, but not everything, and that's why we have a double count on here. So we're actually going to do that sell signal twice, but it's not turning everything off. This will make sense after lunch once you see everything. Let's look at a few charts here on page 44. This is the major market bottom in 09. So again, kind of like the 02, you didn't have a big capitulation bottom like you would expect. It just comes down and stops going lower. So we're coming down here. That would be a pink day rally day. We undercut it, start looking again. Here would be our low with a rally day. We undercut it here. We keep looking. We get a rally day here. It undercuts. We keep looking. So we're not trading in this. We're just observing and watching. And finally, you come down. This is a pink rally day, but you undercut it just slightly. So this is day 0. It doesn't count. But that's our low, that 1265. That's our line in the sand, and that would be your major low because you're out of the market at this point. If we got invested and it undercut that, we sell everything. And you can see why. If you've been coming down for a few years and you try to get in the market, and maybe some of our other sell signals don't get you out. If you undercut that, you don't know how much lower it's going to go. You need to exit that market to protect yourself. But this is day 1. We're not taking action there. Then we get these follow-throughs in here. So we get the 7th day follow-through, 13th, 16th, 17th, 18th, and 23rd. You'll notice on here sometimes we have them grayed out, and that just means that we were fully invested at that point with our other rules, so you wouldn't need them, but just for study purposes, we wanted to go ahead and mark them on the chart. So whenever you see something gray throughout the day, it just means that it didn't really mean anything because you were already either out of the market if it was a sell signal or fully in the market if it was a buy signal. We can see how a real rally starts with many follow-throughs. So that's our B1. That resets our distribution count because it's something new. It's a new rally attempt. We don't know if it's going to work out yet. And then we're adding on these days, if we have room in our account, these are B2s, the additional follow-through days. So they don't reset the distribution, and it wouldn't make sense to reset distribution each time you have one of these days of strength. Does this make sense so far? Yes, sir. Are we buying before the follow-through day? No, it's very rare that we ever buy before a follow-through day. I mean, there are times when we nibble a little bit if you see a perfect setup. And I've known Bill to do it every once in a while. But it's not a good practice to get into because you could get your head handed to you. It's a low probability trade. But if it's a perfect CanSlim stock and it's set up beforehand, then you can give it a shot. But you know you're taking on additional risk. Now, there are other things that, Bill occasionally call a third follow-through day, which is tricky. We've done a lot of study work on it, but it's hard to get rules that he would agree with. But the paper will call sometimes a third day follow-through. And so if the paper calls it, I would go ahead and play with that. But our system is going to use the 4th day and on.
Between the 2 grays, 16 and 70, and then you have the black one right after, that seems a little illogical. If you get one so fast after, you have 2 grays, then you get unfully invested, 17.
Yeah, there would be some sell signals that must have been going on, and by the end of the day, it'll make sense to you. Looking at that right now, I don't really see what would have caused those to be gray. It's not jumping out at me. You'll see how there's ebbs and flows, and most likely we were at a +4, which means 90%. So we go from 100 to 90, back up to 100. That happens a lot. It's probably a bad break on this day, to tell you the truth, but without seeing the percentages on there, that's the only thing it could have been.
What did you do on the B1, right after B1, day after B1, it's like almost a shakeout?
This one? Good question. So the fact that we didn't close below the low of it, we're not going to react with that because we're trying to give it a little bit more room. We were very tedious. We spent a couple years just studying these market bottoms and market tops and a lot of the in-between. And when a lot of the follow-throughs aren't as clean as this, I mean, this pretty much you get a follow-through day, and this is pretty much straight up. But many times you get a follow-through day, and you're going to do a lot of back and forth action, and then it'll go up. So in studying those, we didn't want to react too quickly, so that's why we said, okay, our line in the sand is a close below that. So you could have actually come all the way down into here, and then as long as you closed above the low, we wouldn't be selling based off of that particular rule. No. Yeah. So we studied a lot of things, and the fact is if you look at it on that minute of a level, you're going to be trading even more than we're already trading. And so we want to cut down the noise, but we want to react when we have to. So let's look at another one. This is on page 45. The O2 bottom was over here. We ran up, ran into some problems, And now we're going to go through this 3 waves down and see how the system would get you in, get you out, get you in, get you out, and then get you back in. So over here, we have our low before the rally day. So that must have closed a little bit less than 50%. This was our rally day, day 1. Then we get our follow-through day. So you don't know that this is going to happen. That's all the information that we have is as of that point. We've got 200-day that's in a downtrend. We're running into some resistance. But you have to act on that day and buy. And we were in there buying there. But we have some lines in the sand. So the low of that follow-through day, the B1, that reset our distribution count, was pierced. So at this point, it was pierced and it closed below it. Because it closed below it, we were taking action on that, and it did it in a very big way. Obviously, a huge gap down. It's always possible that that could have turned and rallied back up here, but if I saw that, I'm not going to be waiting till the end of the day. If I sold earlier in the day because this action, and then by the end of the day it snapped back, I'd just adjust whatever trades and put them back on. But this was a clear S1 undercut of the follow-through day. So we sell. And this is our line in the sand right here. So this was our low, not the low of the rally day, but the low that you had established. That was our line in the sand. You can see that it was grayed out because we were already out of the market. We didn't need it. Sometimes you do need an S2, many times, but in this case we had enough other sell signals to get you out. So that turns off the buy switch, which Charles will talk a lot more about a little bit later. So you're out of the market waiting for a follow-through day. You get one over here. So this is a pink day rally day, and we get a 10th day follow-through day. It's in a little bit of a weak position, but you would still act on it, and you would buy. And then we get an S1, where we're closing below the low. So we wouldn't have taken action over here. We're waiting. We didn't take action on this day because it closed back above it, but here you close below it, so it's triggering that S1. We go forward. We get another S2, so it undercuts. And as I said, many of the times when you undercut your prior low, you're just going to snap and turn back up. But you still have to be completely out of the market at that point, intraday, as it's happening. But it's grayed out, so we already had other sell signals that got us out of the market prior to that. Then the rally finally takes hold, and this started a major bull market. So many other things that you can learn from this time frame, but what we're studying here are the B1s and 2s and S1s and 2s. So here, we get a powerful 4th day, follow-through day. That's resetting any distribution that we had over here. And then we get these additional follow-through days. And you can see over here, we were already fully invested, so we didn't need that B2 or this B2. But over here, you did on the 16th day because we had some sell signals that were triggering over here. This is how tricky the market is. It can be very frustrating where you're getting these follow-through days and you get kicked out and you get another follow-through day and you get kicked out. You don't want to abandon the system at that point because eventually it stops and works, and then it leads to making a ton of money when it's there to be made. Peter?
Yes, Mike. Now, this only refers to the NASDAQ.
Yes.
I'm assuming that you're not buying the NASDAQ. You would go over to your 4 or 5 stocks that you bought on the rally day and see if their charts were in the right position to take advantage of the B2s.
Yeah, just to be clear, the system is following the NASDAQ, but if, let's say you didn't get a follow-through day here on the NASDAQ, but you got it on the S&P, you would be taking action, you'd follow whatever the rules are for the S&P, and of course, you'd be looking at your stocks, whether they're on the NASDAQ, on the New York, whatever your watch list is, and you're going to start buying, not on the rally day, but as soon as you get a B1 follow-through day, that's the green light that says, okay, I'm going to start looking. You're looking this whole time, especially once you have a rally day, you have that watch list ready and you're waiting for that follow-through day. You know on a day like this, you can't take any action on these days, so that's when you have all of your stocks ready. Does that make sense?
Yes.
Okay, yes, sir.
How do you check if it's B1? Like 4, 10, 7, sometimes I see that.
Yeah, the B1 can happen at any point on the 4th day or after. It could happen on the 30th day, the 35th day. I don't think we had any that went past 40 days. Without really confusing you, most of the time you're going to have it happen between the 4th and the 10th day. But sometimes it's going to be a little bit later. That's why in your workbooks we wanted to have all of the market bottoms marked up with all of this stuff so you can go home and study and see how it happens all the time. Yes, sir?
Yeah, on the S2, you show that intraday that undercut
Mm-hmm.
follow through, but close that hole. What about if you're not watching intraday? How do you deal with that? Which is more important, the close that hole or the intraday penetration?
That's a good question. How many people have a full-time job where you can't watch the market? Okay. That sucks. And it's good. Lots of the wiggles and wobbles. This is what I would say. Honestly, if you're in a situation where you are over here, right, you're fine not watching it intraday. But if you're getting over here and you're still in the market, now we're out of the market over here, but if you're still in the market, like unless you're a surgeon, how many surgeons do we have? Okay. Oh, you're no. Well, you really, do you have a wife? They could put the trays on for you. When it gets over here, that's really critical. I'd set some sort of alert. You can always put stops on your stocks as well. We don't like to do that, but sometimes you're in a situation, you've got a job where you just can't. At work, we're in meetings all the time, but he allows us to watch our stocks because it's his money, so he doesn't mind. But I would say when you're over here to have some sort of alert system set up on your phone, because it is a big deal. And you can put stops on your stock. So let's say you bought a stock at $100, you put a stop in there like maybe $92 or $95 if it comes down there to sell. The advantage to having a job that doesn't have to do with the market is going to, in the end, help you because all the wiggles and wobbles that Charles and I watch throughout the day, sometimes it gives us an edge, but a lot of times it creates noise and you overthink things and you overtrade. And so I've been trying to actually set up all my meetings these days during trading hours. I used to not do it, but it's helped me slow down my trading. But I'm not a surgeon, so yeah. All right. So let's look at 73, 74. This was a really, really horrific bear market. I did a lot of studying of this time frame. It's fascinating how great stocks can just get killed. Stocks having great earnings, but when you have a market that's really, really bad, it's going to take everything. So this is on page 46. You're coming down, you have a low, then we have a rally day, we get a B1 follow-through day, so you're taking action, you don't know that all of this is going to happen. You get a B2, so this one reset our distribution. This did not, but we're acting on it as a buy signal. Then we get an S1. So we actually close, it's hard to tell, but we close below that low. So we're going to sell some, not everything, based on that rule, but that is one sell signal, so it's a -1. Then here's our line in the sand. So that's an S2, we were already out of the market. So if you were over here, it's these days where I'd be setting the alerts on my phone to make sure I was aware that if you undercut this 69.55, that you start putting some sell signals in. And there are some brokers out there. We trade through Ameritrade for our personal accounts because the firm wants to keep an eye on what we're doing. But I know there are brokers out there that have conditional trades that will be based on something else. So you could probably put an order in, find a broker out there that says, if the NASDAQ penetrates 69, 65, sell XYZ. That might help you out. So then you come down. There's no follow-through attempts in here. We get another one over here, B1, and then our S1, because we closed below that low. And then over here in S2, we were out of the market, but that was our line in the sand, and we're starting fresh again. And you can see we looked at the 09 bottom, which was one of the worst. We looked at the 02 bottom, which was one of the worst of all times. Now we're looking at 73, 74, one of the worst bear markets. And look, there's no capitulation at the end. Just stops going down and starts going up. And that's just the reality of how big, really long bear markets end. Does this look like the end of, at that point, the second worst bear market of all time? No, it's just a nothing day. There's no more sellers out there. Everyone's on the short side, and then they slowly get squeezed. So here we get a rally day. 1, 2, 3, 4. Fourth day, B1. then you're off to the races at that point. You can see all these other follow-through days you didn't need because we had enough signals that we were fully invested already. Is this concept making sense, the S1s and the S2s? Okay, good. And all of the signals throughout the day are really this simple. It's just a lot of moving parts that are going on. There's nothing that we have that's rocket science. It's all just basic stuff, but it's putting all the pieces together. So this is on page 47. I think this is the only chart that we have of something other than the NASDAQ. This is the Dow back then, because the NASDAQ obviously wasn't around. But this is after 1929 was way up here. You come down really, really bad. Anyone trading back then? No? Okay. All right. So here's our rally day. We get a B1, kind of a very weak day, but then you undercut it, so you're selling based on that. And then we get an S2. We undercut. By the end of the day, it snaps back above it, but you're already out if you still had any positions. But it's grayed out because we didn't need it. Then you have a lot going on here. So we get a rally day, 7th day follow through, 9th day B2, 10th day B2. So it's looking really good at this point, but it's starting to roll over slowly. So then we're selling with that S1 right there because you close below it. Notice we're not selling because we've undercut these B2s. It's just the B1, the first initial follow-through day. Then our line in the sand is right there, and we didn't have enough sell signals going on to kick us out. So you can see that this S2 was actually needed. So you have to sell everything as it goes below that. Looks like 43.49. Through this morning session, we've looked at the worst bear markets of all time. And you notice how they all look like this at the end. Just like nothing's going on. So just keep that in mind. The next time we're in a really bad bear market, it's probably going to end like this, because 1932 ended like that, 73, 74, 2002, 2009. Those are all your worst bear markets, and they all end without a capitulation type bottom. So you have a B1 right there, and our line in the sand right there is for our S1, so we never get it. And by this time, we're fully invested, and we have all these additional follow-through days. So that was the end of the follow-through day section.